We all know as a practice owner, one of the last things you want to think about is tax planning and strategizing for your practice. In addition, the long list of tasks on your radar, it's really hard to do everything. You have to find a trustworthy team of experts that understands the unique and specific needs within veterinary medicine. My suggestion would be my friends at Granite Peak Associates. Granite Peak is an advanced tax planning and veterinary practice advisory firm who has spent many years working within vet med. Their team works year round to make sure you're able to maximize your profitability while also minimizing your liabilities. Whether you're in the process of purchasing a practice, looking to grow your practice, or transitioning towards the sale of your practice, they are the experts to help guide you through. What makes them different than other firms is their devotion to proactive tax planning. By thinking into the future and creating long-lasting relationships with their clients, Granite Peak can help minimize the amount of taxes paid over the course of many years to come. Head over to their website, granitepeakcpa.com, to receive a personalized comparison of your practice financials against over 140 other hospitals that they've worked with. You'll be able to see how your practice ranks, where you stack up, and where the opportunities are to get better. From there, you can schedule a one-on-one call with one of the members of their team to review and analyze your results. The opportunity speaks for itself. You need someone on your side. Granite Peak Associates is that team. Take advantage of their innovative expertise within the veterinary industry. Recruiting team members in your veterinary practice has never been this hard. You can either bury your head in the sand and hope it goes away or adapt. Enter Guardian Vets. By leveraging best-in-class technology, you can empower your staff and reduce their workload. Help reduce burnout. You also provide a better experience for your clients and patients, which you want to do as you serve them. The solutions Guardian Vets offers includes after-hours triage, virtual CSRs, that know your team and processes, telemedicine, and so much more. Become the employer of choice in your area by offering the best tools to position your team for success. Whether you're starting a de novo, clinic, multi-doctor, or multi-location, Guardian Vets can help you be more efficient and effective. Go to the website, guardianvets.com, click the Get Started button, then let them know that I sent you, right? Let them know the Vet Success Podcast sent you. Get 50% off your first month. Don't let another quarter or year happen before you start making changes, because you know you need to. So talk to the Guardian Vets team today and implement a new solution. Hey, everyone. Welcome back to another radio show, and excited to chat through some questions. I haven't talked investing that much, honestly, in a while. And obviously, it's a passion and interest of mine, and wanted to kind of go back through. And so I posed the question out on Instagram and within the Facebook group, had some good questions, wanted to run through those. And have probably 3 or 4 interviews coming up. So this will be the last radio show for a while. And I think it's always good to kind of touch on these topics, and especially kind of give some updates if there are anything that's changed. So these are not in any specific order. I tried to order them so they kind of could build on each other. But if my order is slightly off, I might jump around a little bit to reference something from above. But the first one was basically, what should the ideal savings rate be to get to financial freedom? Again, love this question. I think it's a great one. It's always tricky because there's nuance there, and you're going to need more insights. I'll be the first one to raise my hand and say, with all these questions, I'm going to come at it from the experience I had as a certified financial planner in those situations. Obviously, that's not what I'm doing now. I think a financial planner can help answer some of these questions. If you need someone, you have questions, reach out to me. I have lots of great people that I would recommend. They've probably been on the podcast at some point, but if you need help with that, certainly can have some good resources there. But I think it is one that depends on what's your burn rate or lifestyle. What do you want it to look like, and what is it today? And that's going to predicate so much of the answer, right? Because if you're spending a lot, or you have a big, you have a champagne, aspiration, but a beer budget, like, it's going to be tricky to make that work. And so some of it's going to be the input of what you make versus what you spend, but you can't always control what you make. It might just be, hey, right now I can't make more, but I can control what I spend. Same thing, right? You could be in a high cost of living area, and it's tricky to control what you spend because it's out of your control with, what rent will look like or what the mortgage could be because rates are higher. But again, understanding, getting a really good idea of what lifestyle looks like. But to be frank, I would say 20% is the right number to shoot for. Likely is a stretch for a lot of people, especially given where we're at today with inflation and cost of living and all those other things. If you do this a little earlier, hey, you're a new grad, you're listening to this, you do that right from the jump. Maybe you can bring that back to 15% or a little bit less and have a little bit more room if you're doing that consistently over time. If you're later in life and you haven't really done it yet, and you've definitely not saved close to 20, and you're like, hey, it's been single digit, you're going to probably have to dial that up a little bit. I do think it's going to be all about delayed gratification and not trying to, live someone else's Instagram life. And that's tricky. And it depends on kind of the way that you're wired. If that's something that, you can just go along with, it doesn't matter, put your head down and just save and understand that. And for others, it's going to be harder. So you got to know yourself a little bit. But I think, again, I will always say, and I'm going to talk about this later on, I do think being a clinic owner or having some equity in a practice, maybe it's a joint venture with a corporate group, whether it's a big or small group, and having some sort of extra ability for your compensation to grow, I think helps, and you can make up a lot of ground there. I do think private practice is likely the best way to see that really grow, where maybe your savings rate is going to be a lot lower because it is the business and is that big liquidity event down the road. And that can help, even if the multiples aren't going to be as insane as they were in 2021. But with that, I think that goes to the question that is asked on, given economic uncertainty, is starting or buying a practice today still a good idea? Yes, I do think it is. And I think one of the things that it does is it insulates you from some insanity that is the world today. It allows you to kind of put your stamp of how do you want to operate? What do you believe in? Certain things that have happened in the last handful of years, people have been like, I agree with that. I don't agree with that. And so I believe that it will still be challenging. It'll still be stressful, but you can create what you ultimately want. And I do think your income can grow. Now, it's all going to be predicated, again, on is the practice that you're starting or buying, is it a good deal? Are you in an area that makes sense? What's the opportunity set? And again, we'll have a podcast coming up soon. And I keep teasing this from is this location the right location and all that other stuff? That is something I've been working on. I talked about that in the last episode. There's going to be an offering from myself and a business partner to help make sure if you say, hey, I want to open up in Fort Wayne, Indiana, where at in Fort Wayne, Indiana to make sure that you can be successful. And I think armed with good data, it makes it a lot less risky because you have good information. And so that's kind of the thesis on my side. But yes, I think owning a practice still today makes sense. But the other thing to think about is it's all going to be based on what are you paying for it? What's interest rates? Do you have some savings? Because you might not make as much for a little while. It might be a step back before, you see some steps forward. So that is important to understand. But if you are, understanding that you have some savings, you have a little bit of runway, for you to have nothing, you need all your clients to fire you to lose your job, right? You need all of them to say no versus if you're an employee and someone says, hey, you know what? You're done. We need to cut. You're out. And if you can run your business with a profit first motive and ensure that you grow, but you grow at a sustainable pace, that's important too. Like make sure that you're profitable. Make sure that you're not just burning money. And yeah, get a great CPA. Again, you've heard, the ads on this. Granite Peak can be a huge resource for you, right? Get a good CPA that can help you understand what's normal, going through the process. And there are other really good outside partners that can make sure. And I think the risk that people envision for owning a practice can actually be diminished if you have folks on your team that can provide you really good information. Net, yes, you're going to pay them. Net, yes, you're still going to make more than being an associate. And the other thing is, make sure it's a sustainable pace. You're not trying to, get over and above your skis with, I'm going to grow, because I think that's always the push for some people. And I've seen that not work, right? I've been in a company that tried to grow, and it causes issues. There's a local place that I think is really interesting. A good example of this. It's called Dig Dig. But what it is it's this big, basic sandbox with all these toys for little kids to go play. They can rent out for birthday parties. You come in, they sell toys, they mark them up, of course, in the little showroom. But it is a really cool place for young kids. And with having two young boys, they love it, right? Especially when it's cold in Indiana, go dig in the sand, play with the toys, do all that stuff. Well, they were reached out to by Blippi. So anyone that has kids knows Blippi is obviously a huge thing on YouTube and all over the place, that they wanted to do an event there and kind of show what Dig Dig was, right? Huge opportunity for a new business. And they said no. The reason being is they didn't think they could handle the demand. It was too new of a business. That was a really hard decision for them. Is it the right decision? Who knows, right? But I think it's the idea of growing at a sustainable pace where they felt like they couldn't staff it, they couldn't meet demand, and they weren't really ready for that. So, sometimes there's going to be opportunities you need to say yes. And there might be sometimes you're like, that's really great. I'm just not ready for it. And then, what's the upside? If this goes really well, what's the upside? What's the downside? The downside is probably easier to understand. Hey, I have to file bankruptcy. I'm wiped out. I have to restart. The upside, is there asymmetry? Is there, a big upside to this? And I would tell you, you're in an industry, again, that's protected, less competition than a broader, SaaS business or e-commerce business, right? It's harder to become a veterinarian. There is constraints on, who can become a veterinarian, how many veterinarians there are. So it is a really good business. And yes, rates are higher to borrow money to start a clinic. It's going to be higher. So yeah, your hurdle rate's going to be a little bit higher as far as recouping that investment, but it's still, even at 7-8%, better. A well-run clinic is going to outperform that. And so you can borrow money at X rate, and your return as an owner, once you get up and running, and yes, early on you're going to lose money. That's normal. It's still going to be greatly above kind of that 7 or 8%, probably double, if not way more than that. So I still think it makes sense, even with economic uncertainty, who's going to be president, all these other things. You can stress yourself out and make any sort of case of why it's the wrong time. But I would tell you it's still a good time. You should do it and explore it, but find people that can help assist you. And there are lots of the good people, and I've tried to highlight those on the podcast again. What are areas in the investable universe today that are interesting outside of Bitcoin? So this person tried to hamper my conversation by eliminating Bitcoin, which everyone knows my thoughts on Bitcoin if you've listened to this show for long enough. So, I'll cite those episodes, go check them out. But the area outside of Bitcoin that I like, if you don't have a Bitcoin allocation, obviously do that first. Again, qualifier, I'll shut up on it, is oil and gas. And I've made my first kind of non-Bitcoin investments in oil and gas since 2020, honestly, this year. And part of that is, things that have happened, but I'll kind of outline it. So the first one's mineral rights, where you own a percentage of all the oil and gas that a producer comes in when they drill. These big publicly traded companies that come in, and they will extract those resources out of the ground. You get a certain percentage of that. It's monthly income. There's no carrying cost, and the income is kind of low double digits, and you have income for the next 20 years, right? And if you buy good tier one assets, as they talk about it, really good areas where high concentrations of those things in the ground, you can own the acreage that's there, and it allows you to then see those resources. The other nice thing with mineral rights and just oil and gas in general is it plays on the theme of inflation. I'll talk about that in a second. It is a real estate play, and it's 1031 eligible, meaning you can swap from like a commercial investment, let's say your hospital building, into that and just see the funds, and it's tax free. We'll talk a little about that later with a real estate question. Goal is to get your money back in 5 years. Then anything over and above that's all profit. The next one is working interest. This is active participation in drilling oil wells. It's unique because it is active and it offsets actively earned income. Whether you're a W-2 business owner, any of your actively earned income, it can offset it. And so 80% of whatever you invest, so if I invest $100,000, $80,000 of that is a loss against income. So it's a really nice, interesting tax play. Obviously, you still want to make money, so that's important. But for me, the working interest was the area of why I got interested into oil and gas, because of that offset to income. The merger of the old financial firm I worked for, I'm very blessed to receive proceeds in the form of a lump sum with them merging with another firm. So it is a lump sum versus the structured payout that I initially thought in my head, right? And so working interest investment for me makes a ton of sense because I'm a W-2 employee at Swan, and I'm not a business owner anymore, so I can't like do a bunch of reinvestments to offset that as much. I don't have as many, tools in my tool belt at the moment. And so the goal is I can offset that and then recoup that money. Plus, I'm not paying that tax. And so again, if you are in a high tax bracket, if you can just retain the money that you're going to pay, Uncle Sam, that's a huge win. Yes, you still want to make money in the investment, but saving on taxes is also a huge part of that. And so you can take that money and redeploy it over time. So pretty cool strategy there. Goal is to see your initial investment back in 36 to 48 months. And about half of it comes in the first 12 months after you make the investment, once the well is drilled and they get the minerals out of the ground. The assets out of the ground. The company that I've looked at, so people might be wondering, like, hey, Isaiah, is there a company that does this? This is not me doing it myself. I'm not driving out in Texas and Oklahoma and finding these opportunities. It's Eckert Enterprises. Anyone wants to know any more about them, just ping me. I'm happy to share info. They've been great. Been super impressed. Lots of interesting information that they put out. Lots of education, things that I love were for me trying to get up to speed and learn about it. Again, been the first non-Bitcoin thing I've invested in, and there's some reasons why. And I've been really, really impressed. You do have to be an accredited investor. So just FYI on that front. Outside, let's say, hey, I'm not an accredited investor. I don't have $1 million net worth or making, $200,000 or $300,000 a year. How do I still take, a part of that theme? Lots of, publicly traded energy companies outside of minerals and working interest. There are some companies that are minerals plays that are publicly traded that have good yields that are, 8, 10%. Is it perfect? No, it's not going to be the same as owning the physical thing, because stocks are stocks. They're not, real estate. But with that being said, it's similar to like the idea of a REIT, where you can still see some of the proceeds and benefits of oil and gas going up in demand, and also the income that's thrown off of it. I can't tell you what to own. I wish I could just be like, hey, buy these stocks that get me in trouble. But there's lots of places to look. And the reason being is our country is short energy. If you look at, there's never been the history of the world, countries and areas of the world that are low in energy density and high in human flourishing and prosperity. So you need energy for human flourishing. We need a lot more energy. AI takes up a lot of energy, and it's going to take up a ton of natural gas. And that is something that is a thematic play. If you like AI and think AI is going to be this huge thing, you need energy. Well, guess what? Oil and gas is a great play for that. Also, I look at the Bitcoin mining space saying, hey, it's energy intensive. You're going to need energy for that as well. So that's why I look at this as kind of a complementary thing to two big themes that I look out into the world. The other thing that you can look at, I don't think this EV, green theme. I think it's been, ESG has kind of been shown that it's a lot of greenwashing and a lot of it's fake. A lot of it is not actually real. And with that, we don't have enough minerals to even create EV only solutions. And so I like other forms of energy as well. I'm not big on solar. I'm not huge on, some of the different like wind, but I do like uranium. I think nuclear will be a big part of the future. And so you can own some specific spot uranium, or you can look at producers as well. So my thesis on all this energy play, commodity driven. Also think gold is great. Bitcoin's much better, but if you don't like Bitcoin, look at gold. Inflation's not going to go away. It's going to rear its head. And there's more this decade where you're going to need to have something that offsets inflation. So just be sure that you have an investment that can offset that, because a lot of other things won't. Then you can look at a question that was asked: what do you think about whole life IUL policies? Also, how to best protect investments in uncertain economic climates, i.e. now, and how to structure generational wealth. There's a lot to unpack there. I think the first one is, what is considered generational wealth? Everyone's going to have their own number. I might have my own number. I think you can kind of bat around like these ideas of what that looks like. IUL, so index universal life policies. Most of the time, these are strategies for like the 1% that can make sense when they're structured and you've done a lot of other things. But you have to get to that point. And I think most of the time, these policies are sold to the 99% that don't need them, and they end up just being expensive ways to save for the future. And so I would highly, highly, highly caution people from jumping into doing that. And the individual that asked me, for sure, I would tell her specifically, does not need to address her long-term yet with an IUL. I would definitely wait. And I mean, when you think about best protecting investments and thinking about just generational wealth in general, the idea of estate planning and trusts, to me, those are things that you can do, and you can have assets held there where, if you are sued or if there are certain things that happen, you can certainly protect yourself that way a lot better than an IUL policy. And if I think, hey, there's some issues with, the monetary policy in the United States and the dollar and all these other things, all those contracts are written in dollars, and the insurance companies are going to be fairly conservative in general. And yes, with an indexed universal life policy, you can invest in things like the S&P 500 or other kind of indices, but a lot of times they keep the dividend income and it's only the price return. And there's all kinds of games that are played and lots of fees. And I would just highly, highly encourage caution when looking at that. It can make sense, but a lot of times what you see, when they print out like an illustration and show you, it looks like, hey, this thing is the best thing since sliced bread. The nuances and the details, it's probably not going to outperform like saving into a Roth or owning real estate or investing in a clinic. Those are things that you're going to want before looking at the IUL from that standpoint. Next question is, you see all these posts about real estate. It's the best way to build long-term wealth. What are your thoughts? I like real estate. I've had a lot of folks on the podcast that have talked about it. I think some folks will hear me and think otherwise. I just typically think, there's other assets that are better than just owning like commercial or residential properties. And I think for owning real estate, the initial owning should be like the clinic, right? If you're a practice owner or a clinic owner, own the clinic real estate first. And that's great because then you have a lot of freedom and flexibility. With that, you don't have to worry about leases and other things. Again, you have to buy it right, but I think that's where the opportunity lies. Real estate, long-term investment, it's illiquid, can be dangerous if you need a quick buck. And I think a lot of times right now, people that have made, some investments over the last couple of years that had big numbers as far as returns, and then rates changed, they've kind of seen like how bad it can turn, how quickly it can be. But one thing that's nice about real estate is that it is illiquid and helps fight those biases that we have from a personal finance perspective to trade and sell. And so it allows the growth to compound. Now, the biggest question I've always asked real estate folks is, why does real estate accrue value? My opinion is the vast majority of it is due to the fact that we have a broken money and we need a store value asset. And real estate works really, really great for that
because it's going to go up with the rate of inflation and the amount of new monetary units. Real estate's not perfect. It's leaky. Property taxes, repairs and maintenance, all these other things where it's going to leak out value, but it has held up pretty well and it is the number one store value asset in the world. I do think it's still overvalued, but likely will be for the foreseeable future, unless you're measuring it in Bitcoin terms, like a weirdo like me that looks at it and says, hey, real estate prices are falling. They're getting cheaper. I'm going to acquire them in the future. Not yet. And that's kind of my approach there. The other thing that makes real estate really interesting is the tax code. It's advantageous, just like being a business owner for real estate owners. And in terms of cost segregation studies, which can push a lot of taxes and earned income into the future with some offsets, which is great. 1031 exchanges, meaning you can take a building that you bought, it's grown a lot in value, switch it into something else and kind of step up, start with a smaller building, grow. And the idea of like you can take out loans against it, refinance and pull out and buy more, like those have all been really attractive strategies. Biggest thing is passive versus active losses. To get the full tax benefits of being in real estate, you probably need to be a full real estate professional for tax filing. Most veterinarians are not going to be that. Doesn't mean it's a bad thing. It just means something you need to understand, that sometimes, a TikTok video or a blog post that you read, it might have really great content in there, but it's like only if you're a qualified, real estate professional when you file your taxes. You're filing your taxes as a veterinarian most of the time, right? So the one thing I talked about earlier, the working interest, that's the one unique thing and why I was super interested in it, because of the active losses where it actually does give you that. Very, very attractive from that standpoint. And then the last thing is, what's the one thing you've learned about investing that's changed your mind in the last couple of years? I think it's the concentration versus diversification. Early on in your career, you need to be much more concentrated, understand what understand your strengths. That could be owning a practice, owning a clinic. That is the path to wealth. Trying to diversify and just owning index funds from day one. It'll take longer. It's not a bad strategy, but I think the concentration builds wealth, diversification keeps it. That's where I look at it. You only need to win or kind of get wealthy once. Then it's about preservation and adjusting into more diversification. So that is the way that I look at it. Where before I would kind of preach, hey, a diversified portfolio, look over 20 or 30 years. I think the shift in time frame, it's not to say like hurry up and get rich quick, but it's saying like you can concentrate on the things that you have the most ability to drive wealth, which I think from a clinic owner, practice owner is there. Or again, that's partially why I've encouraged people to save into Bitcoin and save into Bitcoin in size, because it does do that as well, where you can be a W-2 employee and still do really well for yourself versus having to go out and take the risk of being a small business owner. But those are the thoughts. I think concentration wins for folks, especially when you're younger. Yes, there's upside and downside of that. It doesn't always work out. And so, take it with a grain of salt. Talk to a professional. They can help you. And so, I'll close there. Covered 6 different things. And let me know if there's any questions on that. As always, please feel free to reach out. Talk soon.
All right. So there are a lot of great job postings that I want to get to. And so we're going to start off with Bayside Hospital for Animals. Great work-life balance in beautiful Fort Walton Beach, Florida. No weekends, Monday to Friday, 8 to 5. No on-call or emergencies. It's an appointment only here. Currently a 2.5 doctor practice. New owner in 2021. Bringing some fresh life into the hospital. The new owner had been there for 6 years prior working, so definitely understands the team, the processes, and the community. Lots of investment in people and new equipment. ProSal is the pay structure. Far too many benefits for me to list. Email BaysideVet251 at Yahoo or call 850-864-1857. Join a thriving, growing small animal practice in Vermont on the Quebec border. Full-time ideal, part-time is considered. The idea is to start with the team, patients and clients, and outdoorsmen or outdoor woman's paradise while being able to practice high-quality medicine. Compensation is write your own structure within production capabilities. Literally, it is the owner wants to find the right person and is happy to negotiate, chat through, and find the right fit. If you want autonomy and a boss that enjoys teaching, reach out to Newport Veterinary Hospital. You can email newportveterinaryhospital@gmail.com. North Central Indiana, looking for an oasis in the chaos. Who isn't, right? Come join the amazing team at Fulton County Veterinary Clinic. They strive to foster a fun, fast-paced work environment while providing quality patient care. They utilize the support staff efficiently so that the doctor is available to practice medicine and do what you're trained to do in less time and paperwork, which is great. Lots of investment in new equipment and technology to support you, full-time or part-time available. Small animal and exotics are both seen there, so no ER. No on-call, no weekends, competitive salary with sign-on bonus offered, and far too many benefits to list. Go to Fulton County Veterinary Clinic. So type that in and you'll find the job posting there. Last but not least, join Watertown Animal Hospital. Personable small animal veterinarian wanted for well-established current 5-doctor mixed animal practice in northern New York, which is an outdoors person's paradise. Again, 2 of those. So if you like the outdoors, you can look at Vermont or New York. They have plenty of support staff with 6 CSRs, 6 licensed technicians, 4 animal caretakers, 2 technical assistants, a hospital assistant, a practice manager, and a bookkeeper. Focuses on mentorship and investment on the people and the technology. That's been a strategic initiative by the leadership team. No on call, 24-hour ER less than an hour away. Salary based on experience, but no less than $95,000. Can be straight salary, pro sal considered. Want to discuss that with the right person. Tons of benefits. Again, too much to list. Please reach out to watertownpetcare.com for that option as well. So again, if you find a role or a job or talk to anyone and it helps you in any way, I would love to hear that feedback. So please reach out. Let me know what you're able to do. And I will continue to post these. So if you are an owner, reach out to me, let me know. And we'll go from there. And until I hit a capacity of I can't keep recording these, I want to let people know who are high quality owners around the country looking for great help. So with that, we'll talk soon.
Thanks for listening to today's show. The comments made on today's show should not be taken as investment, tax, or legal advice. All comments are for educational purposes only. You should talk to your professional team before implementing anything. If you want or need financial advice, my day job and not podcasting is helping veterinarians grow their net worth. Our team is taking new clients, and we are ready to talk to you at any stage of life. Come as you are. I always say, bring the mess, right? Like if things are unorganized, that's okay. There's no prerequisites to become a client. Isaiah Douglas is a partner at Vincier Wealth Management. Isaiah is a registered investment advisor, registered with the SEC. The biggest compliment you can give me in the podcast is to share it with a friend. Reviews help the show get found, and Apple Podcast is the platform that is predominantly used for people listening to the show. If you have 3 minutes, love the show, head over to Apple Podcasts, give us an honest rating and review. It helps more people find the show. Also, the new YouTube channel is up, and I'd love to have you subscribe. Vainly, I want 100 subscribers at least. Lots more, obviously, right? But I get a vanity URL if we get to 100. That would be great. It makes it easier to find the YouTube channel as well. For all of today's links, information, head over to the veterinariansuccesspodcast.com. There you can subscribe to your favorite podcasting platform. It'll be a link to that YouTube channel I just talked about. You won't miss any other episodes, whether you list on Spotify, whether you have some other ancillary podcast platform. Please like, subscribe, all that stuff. It certainly does help. I appreciate it. Finally, if you want more information, insights, want your voice to be heard, want to share ideas for content, say, hey, Isaiah, I want you to have this guest. I want you to talk about this topic. Go over to the Facebook group. So you can search for the Veterinarian Success Podcast on Facebook or head over to veterinariansuccesspodcast.com, scroll to the bottom about your host, click on the Facebook icon, and that'll get you in the group. But thank you so much for listening. It means a lot to me to be able to see the podcast grow and continue to impact people. So with that, until next time, we'll chat soon.